Before we begin, it's important to understand that I am not a licensed financial advisor, and this video is for educational and informational purposes only. The information provided is not intended as financial, legal, or tax advice. Life insurance policies and their benefits can vary greatly between states and providers. You should always consult with a qualified and licensed professional to discuss your individual situation and financial needs before making any decisions. All examples used in this presentation are hypothetical and for illustrative purposes. Picture this. You get a call. It's your doctor. You hear words you never thought you'd hear. Words like malignant, tumor, aggressive treatment. And in that single heart-stopping moment, your entire world grinds to a halt. Everything you were worried about 5 minutes ago, that deadline at work, the leaky faucet, what to make for dinner, it all just evaporates. It's gone, replaced by one single, all-consuming thought. Am I going to be okay? But then, a few days later, after the initial shock begins to wear off and the reality of the fight ahead sets in, a second, colder fear starts to creep in. It's a quiet question at first, a whisper in the back of your mind. How are we going to pay for this? You have good health insurance, you've always paid for the good plan at work. But then you start seeing the numbers, the specialist copays, the out-of-network surgeon, the experimental drug that your plan deems not medically necessary, the $5,000 deductible you have to hit before they even start paying their 80%. And that's just the medical side. What about everything else? You can't work during chemotherapy. Your spouse has to take unpaid leave to drive you to appointments. But the mortgage doesn't stop. The car payment doesn't care that you're sick. The grocery bills, the light bills, the kids' college fund, they all keep coming. Suddenly, you're not just fighting for your life. You're fighting for your financial survival. And you realize with a terrifying clarity that you can beat the cancer and still lose everything. This isn't a scare tactic. This is the brutal reality for millions of Americans. A study from the American Cancer Society found that 42% of new cancer patients drain their entire life savings in just 2 years. Medical debt is the #1 cause of bankruptcy in the United States. You can do everything right, work hard, save money, buy a house, get health insurance, and one single diagnosis can wipe it all out. But what if I told you there was a solution? A financial lifeline that most people have no idea even exists. What if I told you that the key to surviving a financial catastrophe like this might be sitting inside the one financial product you thought you only had to die to use? I'm talking about your life insurance. Now I know what you're thinking. Life insurance? That's for my family after I'm gone. It's a death benefit. And for generations you would have been 100% correct. That's what we were all taught. That's what our parents had, and their parents before them. It was a simple contract. You pay your premiums, and when you die, your family gets a check. End of story. But that story is dangerously out of date. And believing it, clinging to this old definition, is one of the biggest financial mistakes a modern American family can make. Because today, life insurance is not just about a death benefit. It has evolved. It now contains one of the most powerful, yet criminally under-discussed, financial tools available: living benefits. In this video, we are going to pull back the curtain on this revolutionary feature. You are going to learn exactly what living benefits are, the 3 main types, how they work in the real world, and how you can access tens or even hundreds of thousands of dollars from your own life insurance policy tax-free while you are still very much alive to help you get through the toughest time of your life. This isn't about dying. This is about living. It's about giving you the financial power to fight a critical illness without the terror of going bankrupt in the process. It's about having the option to focus on your recovery, not your bills. So why haven't you heard about this? Why isn't this common knowledge? Honestly, there are a few reasons. Part of it is that the industry itself has been slow to educate the public. It's easier to sell the old simple concept of a death benefit. But the biggest reason is simply that this is a relatively new evolution in the world of insurance. Think about it. 100 years ago, if you got a diagnosis like cancer, heart attack, or stroke, it was tragically a death sentence. The medical technology simply wasn't there. So, a death benefit was all that mattered. But look at us now. We live in an age of medical miracles. We have targeted therapies, robotic surgeries, incredible pharmaceuticals. People are surviving these events at an unprecedented rate. Surviving. That's the key word. We are winning the medical battle, but we started losing the financial war that came after. The insurance industry saw this happening. They saw good people, responsible people, losing their homes, their savings, everything they had worked for after surviving a major illness. They realized there was a massive gap, a disconnect between the old purpose of life insurance and the new reality of modern medicine. And so, living benefits were born. They are also known as accelerated death benefits, and they were designed to bridge that gap. The core idea is brilliantly simple. If you suffer a qualifying major medical event, the insurance company will allow you to accelerate a portion of your death benefit and receive it as a lump sum cash payment right now while you are living. Let me say that again because it's the most important concept you need to grasp. You can get a large tax-free check from your own life insurance policy if you get sick. This isn't a loan you have to pay back. It's your money advanced to you when you need it most. It's a fundamental shift in the very definition of what life insurance is for. It's no longer just death insurance. It's life insurance in the truest sense of the word. It ensures your ability to live your life, even when things go horribly, unexpectedly wrong. This money can be used for anything. Anything. There are no restrictions. You can use it to pay your mortgage for a year so you don't have to worry about foreclosure. You can use it to cover your health insurance deductibles and copays. You can use it to hire a home health aide to help with your care. You can use it to fly to the best cancer treatment center in the country, or even seek alternative treatments not covered by your insurance. You can use it to replace your lost income so your family's lifestyle doesn't have to change. It is about giving you control. It's about giving you options and peace of mind when you have none. Now, these benefits typically fall into three main categories, three major life events that can trigger this acceleration. The first is a terminal illness. This is the oldest form of living benefit and the most straightforward. If a doctor diagnoses you with an illness where you are expected to live for 12 months or less, you can access a significant portion of your death benefit. The second, and this is where it becomes a game changer for most people, is a critical illness. This covers catastrophic but often survivable events. We're talking about a heart attack, a stroke, a cancer diagnosis, major organ failure, a severe burn paralysis. These are the events that don't necessarily kill you anymore, but they will absolutely devastate you financially. The third is a chronic illness. This is for when you lose the ability to perform basic daily activities on your own. Think of needing long-term care. If you can no longer perform 2 out of the 6 activities of daily living, things like bathing, dressing, eating, or getting out of a chair on your own, or if you have a severe cognitive impairment like Alzheimer's or dementia, you can access your benefit to help pay for the incredibly high costs of care. Terminal, critical, and chronic. These three pillars of protection transform a simple life insurance policy from a one-dimensional product into a dynamic, comprehensive financial safety net. It protects your family if you die too soon, but it also protects you and your family if you live too long after getting sick. It's the missing piece of the puzzle for most families' financial plans. It's the answer to that terrifying question: how are we going to pay for this? So the big question is, how does this actually work in practice? How do you file a claim? How much money can you actually get? And what are the catches? Because there are always catches, right? We're going to break all of that down piece by piece. We're going to look at real-world examples and show you exactly how this powerful tool can be the difference between a medical crisis and a full-blown financial catastrophe. Stay with me. Let's start with a story about a guy named Mark. Mark is 42 years old. He's a good guy, a family man. He has a wife, Sarah, 2 great kids, a mortgage on a nice house in the suburbs, and a golden retriever named Buddy. By all accounts, Mark is doing everything right. He works hard as a project manager, he's saving for retirement in his 401k, and he's even got a life insurance policy, a $500,000 term life policy to be exact. He bought it years ago, right after his daughter was born. He did it for Sarah and the kids. He sleeps well at night knowing that if the unthinkable happened, if he were to die unexpectedly, his family would be taken care of. The mortgage would be paid off. The kids could still go to college. Sarah wouldn't have to worry about money while grieving. He's protected his family. He's done the responsible thing. One Tuesday morning, Mark is in a budget meeting at work. Suddenly, he feels a crushing pressure in his chest. A sharp pain radiates down his left arm. He's short of breath, dizzy. His colleagues call 911. Mark is having a massive heart attack. He wakes up in a hospital bed, tubes and wires connecting him to a symphony of beeping machines. The doctor comes in and explains what happened. They tell him he's lucky to be alive. They put a stent in one of his arteries, and with rest and cardiac rehab, he should make a good recovery. Mark and Sarah are terrified but immensely grateful. The worst is over. He survived. Or so they thought. Because what Mark and Sarah are about to discover is that surviving a medical crisis is one battle. Surviving the financial fallout is another war entirely. The first wave hits a few weeks later. The hospital bills start to arrive. Even with his decent health insurance from work, the numbers are staggering. His plan has a high deductible. There are co-pays, out-of-network specialists, and prescription costs that aren't fully covered. The total out-of-pocket expenses quickly climb into the tens of thousands of dollars. Then comes the second wave. Mark can't go back to his high-stress job for at least 6 months, maybe longer. He has some short-term disability insurance through work, but it only covers 60% of his base salary, and it doesn't kick in for 30 days. 60% of his salary doesn't cover 100% of their bills. The mortgage payment doesn't shrink. The car payments don't pause. The grocery bills, the utility bills, the cell phone bills, they all keep coming every single month like clockwork. Sarah has to take time off from her part-time job to take care of him, to drive him to his countless doctor's appointments and rehab sessions. So now their household income is slashed by more than half. They burn through their emergency savings in 2 months. Then they start putting groceries on the credit card. Then they have to make a choice between paying the electric bill or the car payment on time. The stress is unbearable. It's a heavy, suffocating blanket that's actually making Mark's physical recovery harder. He's supposed to be resting, focusing on getting better. Instead, he's lying awake at 3 a.m., staring at the ceiling, his heart pounding not from his condition, but from pure financial terror. He's thinking, I have a $500,000 life insurance policy. I did the right thing. Why is it doing nothing for us now? Why is my family going through this? And that is the fundamental, tragic flaw in traditional life insurance. Mark's policy is designed to pay out if he dies. It's a death benefit. It does absolutely, positively nothing for him or his family while he is alive, fighting the biggest battle of his life. The very tool he bought to protect his family from financial ruin is locked away in a vault, and the only key is his own death certificate. Think about the cruel irony of that. The event that is threatening to bankrupt his family, to take away their home, to destroy their financial future, is the very thing his life insurance policy won't cover, because he survived it. But what if there was a different way? What if Mark's policy had a feature that could change everything? What if he could access a portion of that $500,000 death benefit right now, while he is still very much alive? That is the power of living benefits. Living benefits, sometimes called accelerated death benefit riders, are features built into or added onto a life insurance policy that allow the policy owner to access a significant portion of their death benefit while they are still living, if they experience a qualifying medical event. This isn't a loan. You don't have to pay it back. It's an advance on the death benefit your family would have received anyway. You are simply changing the timing of the payout to a time when you desperately need it most. Generally, there are 3 main triggers that unlock these benefits. The first is a critical illness. This is exactly what happened to Mark. It covers things like a heart attack, a stroke, a cancer diagnosis, a major organ transplant, or kidney failure. If you suffer from one of these predefined critical conditions, you can file a claim to accelerate or access a portion of your death benefit. The second trigger is a chronic illness. This is about long-term care. This benefit kicks in if you are certified by a doctor as being unable to perform 2 of the 6 activities of daily living, or ADLs as they're called. These are basic human functions: bathing, dressing, eating, continence, toileting, and transferring, which means moving from a bed to a chair. It can also be triggered by a severe cognitive impairment like Alzheimer's or dementia. This benefit is designed to help pay for long-term care, which can be astronomically expensive, whether it's in a nursing home or with an in-home health aide. The third trigger is a terminal illness. This is the one most people are vaguely familiar with. If you are diagnosed with a terminal condition and a doctor certifies that you have a limited life expectancy, usually 12 or 24 months, you can access a portion or even all of your death benefit. This allows you to pay for experimental treatments, get your affairs in order, take a final family trip, or simply die with dignity, free from financial worry. So let's rewind Mark's story. Let's play it back, but this time, the life insurance policy he bought years ago included a living benefits rider for critical illness. The heart attack still happens. The hospital stay, the fear, the relief of survival, that's all the same. The bills still start arriving. The income still stops. The 3 a.m. panic still tries to set in. But this time it's different. This time, Mark and Sarah make a different phone call. They call their insurance agent. They explain what happened. Mark had a heart attack, a qualifying critical illness. They file a claim. They submit the medical records from the hospital. A few weeks later, a check arrives. A tax-free lump sum check for $150,000. Let that sink in. $150,000. What does that money do for Mark's family? It does everything. It's not just money. It's a lifeline. It's peace of mind. It's control. First, they write a check and pay off all the medical bills. The tens of thousands of dollars in out-of-pocket costs are gone just like that. The debt is erased. Next, they pay their mortgage. Not just for this month, but for the next year. The single biggest threat to their financial stability, foreclosure, is completely off the table. The money replaces Mark's lost income, and then some. Sarah doesn't have to worry about rushing back to work. She can focus on being a caregiver. They can afford healthy food to help with his recovery. They can hire someone to mow the lawn so Mark doesn't have to worry about it. They can focus 100% of their energy on what truly matters, his health. The financial stress, that suffocating blanket, has been lifted. Now you might be thinking, okay, that sounds incredible, but what's the catch? Here it is. That $150,000 they received is deducted from their total death benefit. So, Mark's original $500,000 policy is now a $350,000 policy. When Mark eventually passes away many years down the road, his family will receive $350,000 instead of $500,000. But ask yourself this: which scenario is better? Scenario A, where Mark's family struggles, racks up debt, and possibly loses their home while he recovers, all to preserve a $500,000 payout someday in the distant future? Or Scenario B, where they use $150,000 of that money today to survive the crisis, eliminate the stress, and ensure their financial stability, leaving a still massive, life-changing $350,000 for their future? The choice is obvious. It's your money for your family. Living benefits just give you the option to use it when it can make the biggest possible impact. It transforms life insurance from just a die-too-soon plan into a comprehensive, live-too-long-or-get-sick-along-the-way plan. This sounds amazing, right? Almost too good to be true. And you might be thinking, this must cost a fortune. Or are all living benefits created equal? In the next part, we're going to dive into the cost, the fine print, and the critical differences between policies that you absolutely need to know before you ever sign on the dotted line. So let's tackle that first big question head-on: the cost. When people hear about an amazing feature like this, the first thing they think is, okay, what's the catch? This has to cost a fortune. And the answer, which might surprise you, is not necessarily. In fact, for many of the best policies on the market today, the direct out-of-pocket premium cost for these living benefits is zero. You heard me right. Zero. Zilch. Nada. How is this possible? It comes down to how the benefit is structured within the policy. Think of it like buying a new car. 20 years ago, features like anti-lock brakes or side curtain airbags were expensive add-ons. You had to specifically ask for them and pay extra. Today they're standard. They're built into the base price of the car because the technology has evolved and consumer demand has made them essential safety features. Life insurance has gone through a similar evolution. Many modern, forward-thinking insurance companies now consider living benefits to be an essential, core feature of a life insurance policy. They're not an add-on, or what's known in the industry as a rider. They are baked right into the chassis of the policy itself. So when you pay your premium for the life insurance, you're also getting these powerful protections included, without an additional line item charge. Now, that's not to say all living benefits are free. Some specialized or more robust versions can still be riders that you add to a policy for an extra cost. For example, a comprehensive long-term care rider might add a percentage to your premium. But the core three we've been talking about, critical, chronic, and terminal illness benefits, are very often included at no additional premium. This is one of the single biggest misconceptions out there. People assume it's a luxury feature, when in reality, it's becoming the new standard. But this brings us to the much more important question. If it doesn't cost extra in your premium, where does the cost come in? This is where we have to look at the fine print. Because the real cost of living benefits isn't paid with your monthly premium. It's calculated at the moment you actually need to use the money. When you trigger a living benefit, you are doing something called accelerating your death benefit. You are, in essence, asking the insurance company for an advance on the money they were eventually going to pay to your family. And just like any advance, there's a trade-off. Let's break this down with a simple analogy. Imagine your rich uncle promises to give you $10,000, but not until your 40th birthday, which is 10 years away. That's a guaranteed 10 grand in the future. But what if you have an emergency today? You go to your uncle and say, I know you promised me $10,000 in 10 years, but I really need some of that money right now. Your uncle, being a savvy guy, might say, okay, I'll give you some of it now. But $10,000 in 10 years is not the same as $10,000 today. Because of inflation and the interest I could be earning on that money for the next decade, the present value of that future 10 grand is actually closer to, say, $8,000. So I'll give you $8,000 today and we'll call it even. The insurance company does almost the exact same thing, just with a more complex formula. When you file a claim, say for a critical illness, the insurance company's actuaries get to work. They look at your policy's death benefit. Let's say it's $500,000. They look at your current age and, based on your new medical diagnosis, they calculate your new reduced life expectancy. They factor in the current interest rates and other variables. Based on this calculation, they determine the present-day value of the money you're asking for. So, if you want to accelerate $100,000 from your $500,000 policy, they won't just write you a check for $100,000. They'll run their formula and might come back and say, okay, based on your condition and current interest rates, the present value of that $100,000 is $75,000. They will offer you a lump sum payment of $75,000, tax-free. If you accept it, your death benefit is then reduced by the full $100,000 you accelerated. So your new death benefit for your beneficiaries would be $400,000. That $25,000 difference? That's the cost. It's the discount the insurance company takes for giving you the money now instead of many years from now. It's their compensation for the loss of time and interest. This is the single most important piece of fine print to understand. You are trading a portion of your future death benefit for a smaller, but still substantial amount of cash in your hands today. And for someone battling cancer or recovering from a stroke, having that immediate tax-free cash to eliminate financial stress is often a priceless trade-off. But this leads us to the final crucial point. Are all living benefits created equal? Absolutely not. This is where the differences between insurance companies become night and day. It's not just about the discount rate they use. It's about the very definitions they use to decide if you qualify in the first place. The contract language, the definition section of your policy, is everything. Let's take a critical illness like a heart attack. Company A might have a very strict definition. They might require that the heart attack results in a certain ejection fraction, a measure of your heart's pumping ability, falling below a specific number. If your heart attack was serious but not that serious according to their specific metric, your claim could be denied. Meanwhile, Company B might have a much broader definition. They might simply state that a diagnosis of a myocardial infarction, confirmed by a board-certified cardiologist with corresponding EKG changes, is enough to trigger the benefit. Same real-world event, two wildly different outcomes based on the fine print. The same is true for cancer. Some policies cover any form of invasive cancer. Others might exclude certain types like skin cancer unless it has metastasized. For chronic illness, the triggers are the activities of daily living, or ADLs, that we talked about before: eating, bathing, dressing, and so on. Most policies say you qualify if you can't perform 2 out of the 6. But what if you have a cognitive impairment like Alzheimer's? Some of the best policies will automatically qualify you based on a cognitive impairment diagnosis alone, even if you can physically perform all 6 ADLs. Other, less favorable policies won't. That is a massive, life-altering difference in the contract. Another critical difference is how the money is paid out. The most flexible policies will pay you a lump sum of cash. You receive the check and you can do whatever you want with it. Pay your mortgage, hire a home health aide, cover experimental treatments, take your family on a trip to make memories. It's your money, no strings attached. However, some policies, especially older ones or those with specific long-term care riders, operate on a reimbursement basis. This means you have to first incur a qualified expense, pay for it out of your own pocket, submit the receipt, and then the insurance company pays you back. This is far more restrictive and creates a cash flow problem right when you need it least. You also have to look at the limitations. How much of your death benefit can you actually accelerate? Some companies cap it at 50%. Others might let you access up to 90% or even 100% in the case of a terminal illness. Is there a dollar figure cap, like $1 million or $2 million regardless of your policy size? Are there waiting periods after your policy is issued before you can make a claim? All of these details, the trigger definitions, the payout method, the benefit caps, are buried in the policy contract. And they are the things that separate a policy that is a true financial lifeline from one that's just a piece of paper with empty promises. This isn't about finding the cheapest policy. It's about finding the one with the strongest, most claimant-friendly contract language. Because when you're sick, the last thing you want to do is fight with an insurance company over a technicality in the fine print. The policy should be there to serve you, not the other way around. So now you know the mechanics, the costs, and the traps to avoid. But what does this look like in the real world? In the next part, we're going to walk through 3 dramatically different real-life case studies. We'll meet a young family hit by a critical illness, a business owner facing a chronic condition, and a retiree needing terminal illness care. You'll see exactly how these benefits played out, the exact dollar amounts they received, and the life-changing impact it had. Or in one cautionary tale, the impact it didn't have because they chose the wrong policy. Let's start with the story of Mark, a 45-year-old construction manager from Texas. Mark was the textbook definition of a family man. He worked hard, coached his son's little league team, and was planning on taking his wife, Jessica, and their 2 kids to see the Grand Canyon that summer. Like many of us, he bought a life insurance policy a few years back. It was a $500,000 term policy. He saw it as a necessary evil, a box to check. He figured, if I die, Jessica and the kids are taken care of. He never thought about it again. For him, the policy was only valuable if he was gone. He was wrong. One Tuesday afternoon, after weeks of what he thought was just bad indigestion, Mark got the news that shattered his world. Stage 4 pancreatic cancer. The doctors gave him at most 18 months. The emotional devastation was immediate and absolute. But the financial devastation started to creep in just a few weeks later. The chemotherapy was brutal. Mark couldn't work. His short-term disability from his job helped, but it was only 60% of his regular income, and it was about to run out. Jessica had to cut her hours at her nursing job to take him to appointments and care for him at home. So, their income was slashed by more than half, but their expenses exploded. Health insurance covered a lot, but it didn't cover everything. There were co-pays, experimental treatments they wanted to try, and medications that cost thousands out of pocket. More than that, it was the everyday bills that became an anchor, dragging them down. The mortgage on their dream home, the 2 car payments, the grocery bills. They burned through their emergency savings in 3 months. Then they started pulling from their 401k, paying the taxes and penalties, just to keep the lights on. Every single day was a battle, not just against the cancer, but against a rising tide of debt and stress. The Grand Canyon trip was a forgotten dream. Their new dream was just making it to the next month. One night, sitting at the kitchen table buried in a mountain of bills, Mark remembered the life insurance policy. He felt a dark sense of irony. Here he was, with a $500,000 asset to his name, but it was completely useless. It might as well have been on the moon. He called his financial advisor the next day, mostly just to vent his frustration. But the advisor asked a simple question. Mark, does your policy have an accelerated death benefit rider? Mark had no idea what that meant. The advisor explained that this rider, which had been included in his policy for no extra cost, allowed him to access a significant portion of his death benefit while he was still alive if he was diagnosed with a terminal illness, typically defined as having 12 to 24 months left to live. It was a lifeline. They submitted the claim, along with the documentation from his doctors. The process was surprisingly fast. The insurance company approved him to accelerate 80% of his death benefit. That was $400,000. The money was deposited into their bank account, completely tax-free. I want you to pause and really think about what that meant. $400,000. The very next day, Mark wrote a check and paid off their entire mortgage. Gone. He paid off both of their cars. Gone. He set aside money for any and all medical treatments he wanted to try, giving him a sense of control over his own fight. He put a substantial amount into a college fund for his kids, ensuring their future was secure no matter what. But here's the most important part. With the financial pressure completely gone, the cloud of stress lifted from their home. Jessica was able to stop working entirely to be with him. They weren't fighting about bills anymore. They were just together. They spent the next 8 months not worrying about money, but making memories. They didn't make it to the Grand Canyon, but they rented an RV and drove to the coast. They had barbecues with family. They watched movies. They lived. When Mark passed away 14 months after his diagnosis, he did so with dignity in his own home at peace, knowing his family was okay. And that remaining $100,000 from his policy, That was paid out to Jessica as a traditional death benefit, giving her a cushion to grieve and figure out her next steps without having to immediately rush back to work. Mark's living benefits didn't save his life, but they absolutely saved his family's quality of life during its most difficult chapter. Now let's look at the other side of the coin. This is the cautionary tale. The story of what happens when you have a policy that doesn't have these features. Meet Sarah, a 52-year-old graphic designer from Pennsylvania. She was diagnosed with ALS, also known as Lou Gehrig's disease. For those who don't know, ALS is a progressive neurodegenerative disease that is, unfortunately, always terminal. But unlike Mark's aggressive cancer, the timeline for ALS can be much longer, often 3 to 5 years, sometimes more. Sarah also had a $500,000 life insurance policy. She bought it 15 years ago from a company that was famous for having the absolute lowest prices. But to get that rock-bottom price, the policy was stripped down to the bare bones. It had no riders, no living benefits. It was a pure death benefit and nothing more. As her disease progressed, Sarah could no longer use her hands, so her career was over. Her husband, Tom, had to retrofit their home with ramps, a chairlift, and a handicapped accessible bathroom, costing them over $50,000 out of pocket. Soon, Sarah required 24/7 care, and Tom had to leave his job to become her full-time caregiver. Their income went to zero. They had a $500,000 asset in that life insurance policy, but it was locked in a vault they couldn't open. They were, in a phrase you should remember, insurance rich and cash poor. They did what Mark and Jessica did. They drained their savings. They liquidated their retirement accounts. They sold their home of 20 years and moved into a small, cramped rental to free up equity. They racked up over $100,000 in credit card debt, just to pay for caregivers and medical supplies. Their lives became a living hell of financial stress piled on top of unimaginable emotional and physical strain. Every single day was a struggle. Tom was exhausted, burned out, and terrified for their future. Sarah felt like an immense burden, watching the man she loved sacrifice everything as they slowly went broke. 4 years after her diagnosis, Sarah passed away. A few weeks later, a check for $500,000 arrived from the insurance company, just as promised. But what did that money do? First, it paid off the $100,000 in credit card debt. Then, it had to replenish the retirement accounts they had raided. It had to cover the funeral costs. By the time the financial dust settled, Tom was left with a fraction of the original amount. The money didn't provide a legacy. It just cleaned up the financial wreckage that was created while Sarah was still alive. It got him back to zero. The insurance came far too late to help them when they truly needed it. Look at the two stories. Mark and Sarah. Both had a $500,000 policy. Both faced a terminal diagnosis. But the outcomes for their families were night and day. Mark's policy gave his family peace, dignity, and precious time. Sarah's policy was just a cleanup fund for a financial disaster that had already happened. The difference wasn't the amount of coverage. It was a feature, a rider, that Mark probably didn't even know he had when he bought the policy. These stories are powerful, but they both deal with a terminal diagnosis. What happens when the illness isn't going to end your life, but it's going to change it? Forever? What if you have a massive heart attack, a stroke, or get a diagnosis like multiple sclerosis? That's where the chronic illness rider comes in, and the rules for accessing your money are completely different. In the next part, we'll break down exactly how that works, and you'll meet a man whose life was saved not by a doctor, but by a clause in his policy he didn't even know he had. His name was Mark. 46 years old, owned a successful contracting business, 2 kids in high school, and a mortgage that felt more like a trophy than a burden. He was the picture of the American dream built with his own 2 hands. He did everything right. He had health insurance through his business, a 401k he maxed out every year, and a $500,000 term life insurance policy he bought a decade ago, mostly to appease his wife. To him, that policy was a file in a cabinet, a check he wrote every month for something he hoped his family would never, ever need. It was death insurance. Simple as that. Then came the Tuesday morning that started like any other and ended with the shriek of sirens. A massive heart attack. The kind they call a widowmaker. He didn't even make it to the local hospital. They airlifted him straight to a cardiac specialty center 2 hours away. The doctors saved his life, performing a complex triple bypass surgery. But in many ways, the real crisis was just beginning. Mark survived, but the man who came home wasn't the same one who left. He was weak, exhausted, and forbidden from working for at least 6 months, maybe longer. And that's when the other invoices started arriving, the ones that had nothing to do with medicine. The helicopter ride alone was $52,000, a cost his health insurance deemed out of network and refused to fully cover. The specialized care, the weeks in the ICU, the endless prescriptions. The bills piled up into a mountain of debt that seemed to grow overnight. But the real killer wasn't the medical debt. It was the loss of income. Mark was his business. Without him on job sites, managing crews, and bringing in new clients, the business ground to a halt. The family's savings, the money they'd carefully set aside for college and retirement, began to evaporate, draining away to cover the mortgage, the car payments, and the simple cost of living. His wife, who had been a stay-at-home mom, was now working 2 part-time jobs, her face etched with a constant, quiet panic. The stress was suffocating. Mark felt like he was drowning his family, his survival becoming the very thing that was destroying their future. One night, sitting at the kitchen table, staring at a stack of red-stamped past due notices, he told his wife, "That life insurance policy, it's a cruel joke. It's worth $500,000, but only if I had just died on that helicopter. We could use that money now. We need it now." It was a thought he was ashamed of, but it was the truth. The solution to their financial nightmare was locked behind the one thing he had fought so hard to avoid: his own death. What Mark didn't know is that the industry had changed. The policy he bought a decade ago wasn't just a death certificate with a dollar sign attached. Buried in the fine print, included for no extra premium, was a feature called an accelerated death benefit rider for critical illness. His financial advisor called him for a routine check-in, heard the despair in Mark's voice, and asked one simple question. "Mark, have you told your life insurance company about the heart attack?" Mark scoffed. "Why? So they can raise my rates or cancel on me?" "No," the advisor said. "So you can file a claim." This is the moment where everything changes. This is the pivot point from old-school life insurance to the modern financial tool it has become. Living benefits are not a loan. You are not borrowing against your policy. You are accelerating a portion of your death benefit for your use right now while you are alive. Here's how it worked for Mark and how it works for millions of Americans who have this feature and don't even know it. The process is remarkably straightforward. First, a trigger event must occur. For Mark, that trigger was the heart attack. For others, it could be a cancer diagnosis, a stroke, major organ failure, or a number of other specified critical conditions. Second, you file a claim. This isn't like filing a health insurance claim with endless paperwork. It's typically a few forms and, most importantly, the medical records proving the diagnosis. Mark's advisor helped him gather the records from the hospital and submitted the claim. Third, the insurance company evaluates the claim. They aren't just verifying the heart attack. They are performing a crucial calculation. They look at the severity of your condition and how it has impacted your life expectancy. Let's be blunt. A major heart attack at 46 means statistically, you're not likely to live as long as you were before. Based on this new, reduced life expectancy, the insurance company makes you an offer. This is the part that confuses most people, but it's actually simple if you think about it. The insurance company was on the hook to pay Mark's family $500,000 someday in the future. Now, because of his heart attack, that someday is likely to be much sooner. They offer to pay him a portion of that benefit today. The offer is a discounted, lump sum amount. Why is it discounted? Because $1 today is worth more than $1 20 years from now. They are essentially buying a portion of their future liability back from you, at its present value. In Mark's case, the insurance company came back with an offer. They would accelerate $300,000 of his $500,000 death benefit, paid to him directly in a single tax-free lump sum. He had the right to accept the full offer, a partial amount, or reject it entirely. If he took the $300,000, his remaining death benefit for his family would be $200,000. It's a trade-off. You're trading a future, larger benefit for a smaller, immediate one. For Mark, it wasn't even a choice. Within 2 weeks, a check for $300,000 was in his bank account. And this is where the story shifts from being about survival to being about recovery. That money didn't just pay off the helicopter bill or the mortgage. It did something far more powerful. It bought peace of mind. It meant his wife could quit her 2 jobs and be by his side, focusing on his care, not on the bills. It meant they could hire a manager to keep his business running, protecting the legacy he had built. It allowed him to go to the best cardiac rehab facility, not just the one down the street. Most importantly, it removed the crushing, suffocating financial stress that so often leads to depression, setbacks, and even second heart attacks. The money allowed Mark to focus on one thing and one thing only: getting better. The clause in his life insurance policy didn't just save his family's finances. It very likely saved his life by giving him the freedom to heal. Mark's story is a perfect example of a critical illness rider. But this is just one of 3 major categories of living benefits. The second is for chronic illness. This isn't triggered by a sudden event like a heart attack, but by a long-term decline. It's for when you can no longer take care of yourself, when you can't perform 2 of the 6 activities of daily living, like bathing, dressing, or feeding yourself. This is the benefit that addresses the catastrophic cost of long-term care. The third is terminal illness. This is the one most people have heard of. If a doctor certifies that you have a limited time left to live, typically 12 to 24 months, you can access a significant portion of your death benefit to get your affairs in order, travel, or simply live out your final days with dignity and without financial worry. Critical, chronic, and terminal. These are the 3 pillars of modern life insurance. They transform a simple death benefit into a comprehensive safety net for life's most devastating challenges. Mark's story was about a sudden catastrophic event that almost derailed his entire life. But what happens when the crisis isn't a sudden explosion, but a slow, creeping decline? What happens when you're the one who needs constant care? That's when the rules for accessing your money change once again, and are tied to 6 simple human actions that can unlock your policy and protect your family from the single biggest threat to their retirement savings. These 6 actions aren't complex legal terms or obscure financial jargon. They are the fundamental building blocks of an independent life. In the world of insurance, they're known as the activities of daily living, or ADLs. And understanding them is the key to understanding how you can protect your life's work from the crushing cost of long-term care. The trigger, the moment your policy transforms from a death benefit into a living benefit, is when a doctor certifies that you can no longer perform just two of these 6 activities without substantial assistance. Let's make this real. Forget the policy language for a moment and let me tell you about a guy named Frank. Frank was a carpenter his whole life. Hands like leather, back strong as an oak tree. He built his own house, raised 3 kids in it, and planned to spend his retirement in his workshop, making rocking chairs for his grandkids. At 68, he was living the dream. But life, as it so often does, had other plans. The first domino fell in the most ordinary of places, the shower. A simple slip. He didn't break anything, but the fall shook his confidence. His wife, Sarah, insisted on putting a chair in the shower and grab bars on the wall. This is where the first ADL comes into play: bathing. It's not just about being able to stand under the water. It's about the ability to get in and out of the tub or shower safely, and to wash yourself all on your own. For now, Frank was fine. He grumbled about it, but he could manage. A year later, the arthritis that had been a dull ache in his knuckles for a decade began to rage. His gnarled fingers, which had once framed entire houses with precision, could no longer manage the delicate task of buttoning his own shirt. He couldn't bend over to pull on his socks without excruciating pain. Sarah had to help him get ready every morning. This is the second ADL: dressing. The ability to put on and take off your clothes. Seems so simple until you can't do it. Still, Frank was only struggling with one ADL. His policy hadn't been triggered. He was just a guy getting older. The turning point came on a cold Tuesday in November. Frank tried to get out of his favorite armchair to go to the bathroom and his legs just wouldn't cooperate. He was stuck. He had to call for Sarah to help pull him up. This introduced the third and fourth ADLs at the same time. The third is transferring. The ability to move from a bed to a chair, or a chair to a wheelchair. It's about mobility within your own home. The fourth is toileting. The ability to get on and off the toilet and perform the associated personal hygiene. Think about the profound loss of dignity in that moment. The man who built the house with his own 2 hands could no longer get out of a chair by himself. He now needed help with dressing, transferring, and toileting. That's 3 out of the 6 ADLs. His doctor officially certified his condition. And with that, a phone call was made to the insurance company. The switch was flipped. Frank's life insurance policy, the one he bought to protect Sarah if he died too soon, was now activated to protect their savings while he was still very much alive. The policy began paying out a substantial, tax-free monthly benefit that they used to hire a home health aide for a few hours every day. This allowed Sarah to remain his wife, not his full-time, exhausted caregiver. It allowed Frank to stay in the home he built, surrounded by the memories he cherished. The final 2 ADLs, thankfully, Frank didn't struggle with for a long time. The fifth is continence, which is the ability to control one's bladder and bowels. And the sixth is eating, which isn't about cooking food, but the physical act of being able to get food from a plate into your mouth. So let's recap them. Bathing, dressing, transferring, toileting, continence, and eating. The inability to do just 2 of these 6 tasks is what unlocks the long-term care benefit inside a modern life insurance policy. This is a universe away from the old way of doing things. For decades, the only option was traditional long-term care insurance. And many people got burned. They paid premiums for years, sometimes decades. Then the premiums would skyrocket, doubling or even tripling, forcing them to either pay the exorbitant new price or walk away, losing every single dollar they had ever paid in. It was a use-it-or-lose-it gamble. With a life insurance policy that has a living benefits rider, you eliminate that gamble. If you never need long-term care, your family still receives the full, tax-free death benefit when you pass away. You don't lose anything. The money you paid in still serves its original purpose. But if you do need care like Frank did, the policy is there for you, transforming into a source of cash to protect your dignity and your retirement accounts. But physical decline is only half the story. There is another, arguably more terrifying, path that can trigger these benefits. It's a path that doesn't involve a single broken bone or a single stiff joint. It's the loss of the mind. The second major trigger for these benefits is a severe cognitive impairment. This is the clause that covers diseases like Alzheimer's and dementia. If a doctor certifies that you require substantial supervision to protect yourself from threats to your health and safety due to a cognitive decline, the benefit is triggered. You could be physically fit as an ox. You could be able to run a marathon, but if you can't be left alone because you might wander out of the house or forget to turn off the stove, you qualify. This is monumental, because the cost of memory care can be even more staggering than the cost of physical assistance. It often requires 24/7 supervision in a secure facility. Imagine Frank's wife, Sarah. What if, years later, it was her mind that began to fade? She might be able to perform all 6 ADLs perfectly. She can dress herself, bathe herself, feed herself. But she can't remember her own address. She doesn't recognize her own children. Frank, now older and frilier himself, cannot possibly provide the constant supervision she needs. Her life insurance policy, with its cognitive impairment trigger, becomes their financial lifeline. It pays for a specialized memory care facility, a place where she can be safe, cared for, and live with dignity, without forcing Frank to sell the house and spend every last penny they have saved. This 2-pronged trigger, needing help with 2 of the 6 ADLs or suffering a severe cognitive impairment, creates a comprehensive safety net. It protects you from the 2 biggest threats of aging: the decline of the body and the decline of the mind. It addresses the silent fear that keeps so many people awake at night. The fear of becoming a burden, of watching your life savings, your 401k, your home equity, get vaporized by a health crisis in the last years of your life. This isn't about dying. It's about how you live. It's about ensuring that a health problem doesn't become a wealth problem for your entire family. It's about having a plan that gives you control and options when you feel like you're losing both. Frank and Sarah had a plan. They turned their life insurance into a fortress around their retirement, ensuring that no matter what health challenges came their way, they would face them with dignity, and their financial legacy would remain intact for their children and grandchildren. Now, knowing you qualify is one thing, but the real question, the one that truly matters when the bills start rolling in, is about the money. How much do you actually get? Is it a small percentage? Is it the full death benefit? And how is that amount calculated? The answer lies in a simple process that gives you incredible flexibility, allowing you to choose between a monthly income for life or a massive lump sum of cash, all based on a single critical assessment from your doctor. That assessment from your doctor is the key that unlocks everything. It's the starting pistol for a process that's surprisingly straightforward. When you file a living benefits claim, the insurance company doesn't just take your word for it, and they don't just take your doctor's word for it either. They take that diagnosis, your medical records, your doctor's prognosis, and they send it to an independent third-party underwriting team. These are medical experts whose entire job is to analyze complex health situations and provide an impartial life expectancy estimate. This isn't about being morbid. It's a purely financial and actuarial calculation. They might come back and say, based on this specific type of cancer and its progression, the patient's life expectancy is 24 months or less. Or for a chronic condition like a severe stroke, they might determine that while you'll live for many more years, you meet the criteria of being unable to perform 2 of the 6 activities of daily living, like bathing and dressing. Once that life expectancy is established, the math begins. And this is where most people get confused, but it's actually very simple when you understand the insurance company's perspective. Let's imagine you have a $1 million policy. You get a terminal diagnosis, and the underwriters confirm you have about 12 months to live. Now you might think, great, give me my $1 million. But that's not quite how it works. The insurance company won't give you the full $1 million. And the reason why is common sense. They are in the business of managing money over time. By giving you your death benefit before you die, they are losing out on two things. First, they're losing any future premiums you would have paid. Second, and more importantly, they are losing the time value of that $1 million. They had that money invested, earning interest, and they were planning on it staying invested for at least another year, or maybe decades longer if you were young. So they give you an accelerated benefit. They are fast-forwarding your death benefit into the present day. To do this, they apply a discount. Think of it as the fee for getting your money decades ahead of schedule. The size of that discount is directly tied to that life expectancy assessment we just talked about. The shorter your life expectancy, the smaller the discount, and the more money you get. Let's run the numbers. On that $1 million policy with a 12-month life expectancy, the company knows they were going to have to pay out that $1 million very soon anyway. The discount will be relatively small. They might offer you 85% of your death benefit. That's $850,000. Cash, tax-free, in your bank account, ready to be used for anything you want. But what if your diagnosis was for a chronic illness, not a terminal one? Let's say you're 50 years old, you have a severe case of multiple sclerosis, and you can no longer work or care for yourself. The medical assessment might say you have a normal life expectancy, maybe another 30 years. But you need the money now. In this case, the insurance company looks at it very differently. They were expecting to hold on to that $1 million and keep it invested for another 30 years. They were also expecting you to keep paying premiums for 30 more years. Giving you a huge chunk of that money today represents a much larger financial adjustment for them. So the discount will be bigger. They might offer you 50% of your benefit or $500,000. Still a life-changing amount of money, but you can see how the life expectancy directly impacts the offer. The longer you're expected to live, the larger the discount, because they're giving you the money further in advance of when they thought they'd have to. This is where the incredible flexibility comes in. You get the offer from the insurance company, and the power shifts entirely to you. You get to decide. Let's go back to our terminal cancer example. You've been offered $850,000. Now you face a choice, and it's a choice that can shape the rest of your life and your family's future. Option 1 is the lump sum. You tell the insurance company, "Yes, I'll take it." They cut you a check for $850,000. This money is yours free and clear. You can use it to pay off your mortgage, ensuring your spouse and kids will always have their home. You can prepay for your kids' college education, lifting that burden from your family forever. You can seek out the best experimental treatments anywhere in the world, sparing no expense to fight for more time. You can take your entire family on a once-in-a-lifetime trip, creating memories that will last long after you're gone. The control is absolute. But there's another option, one that provides a different kind of peace of mind, a lifetime income stream. Instead of taking the massive lump sum, you can ask the insurance company to convert that $850,000 into a guaranteed monthly paycheck for the rest of your life. This is where their actuaries come in again. Based on your age and life expectancy, they'll calculate a monthly amount. It might be $10,000, $12,000, or even $15,000 a month, every single month, for as long as you live. Why would someone choose this? Imagine your primary concern isn't a big expense, but replacing your lost income. You were the primary breadwinner, and now you can't work. A guaranteed, tax-free check arriving every month like clockwork means your spouse doesn't have to worry about the bills. The lights stay on. The mortgage gets paid. Life can maintain a sense of normalcy and stability during an incredibly unstable time. It removes the burden of managing a large sum of money and protects you from the temptation of overspending. It's a fortress of financial security, a promise that no matter what, the basics are covered. And here's one of the most important, most misunderstood parts of this entire process. What happens to the rest of your life insurance? If you take the $850,000 lump sum from your $1 million policy, what happens to that other $150,000? Does it just vanish? Absolutely not. The amount you accelerate is simply subtracted from your original death benefit. So, in this case, your new death benefit becomes $150,000. When you eventually pass away, your family will still receive a check for $150,000 tax-free. You get to use the vast majority of your policy while you're alive to solve your immediate crisis, and your family still gets a financial cushion when you're gone. It's the ultimate win-win. You are not destroying your legacy. You are simply reallocating it to fight the battle that's right in front of you. This feature is what transforms life insurance from a simple die-to-win product into a comprehensive financial tool for the living. It's a Swiss Army knife for life's worst-case scenarios. Whether you need a giant pile of cash to solve big, immediate problems or a steady, reliable income to provide stability and peace of mind, the choice is yours. All of this is triggered by that one single diagnosis from your doctor, turning a piece of paper that represents your worst fears into a financial rescue plan that gives you power, control, and options right when you need them most. But that diagnosis, that single moment, isn't limited to just a heart attack, a stroke, or cancer. The power and control we're talking about extends to situations that are slower, more gradual, but just as devastating to a family's financial and emotional well-being. This brings us to the second major category of living benefits, and it's one that addresses a silent fear for millions of Americans: the fear of becoming a burden. I'm talking about a chronic illness. Now, a chronic illness in the world of living benefits isn't just a condition you manage with medication. It's defined in a very specific and very human way. It's triggered when a doctor certifies that you are unable to perform 2 of the 6 activities of daily living without substantial assistance. These 6 activities are the fundamental things we all do every day without a second thought: bathing, dressing, eating, continence, toileting, and transferring, which means moving from a bed to a chair. Think about that for a second. These are the markers of our independence. And when you can no longer do 2 of them on your own, your life changes forever. And so does the life of your family. Let me tell you about a man named David. David was a carpenter, a man who built homes with his own 2 hands. Strong, proud, the rock of his family. In his late 50s, he was diagnosed with a degenerative neurological condition. At first it was just tremors. Then it became difficult to button his own shirt. Within a couple of years, David, the man who could frame a house, couldn't safely get in and out of the shower by himself. He couldn't dress himself. He had lost the ability to perform 2 of the 6 activities of daily living. His wife, Mary, had to quit her part-time job to become his full-time caregiver. Their savings, the money they had carefully put away for a comfortable retirement of travel and grandchildren, started to evaporate. It was being eaten alive by medical equipment, home modifications, and the simple loss of her income. The emotional toll was immense. David felt a profound sense of shame and helplessness, watching the woman he loved struggle to care for him, watching their dreams dissolve. Mary was exhausted, physically and emotionally, caught between her love for her husband and the crushing weight of their new reality. This is the slow-motion financial catastrophe that a chronic illness can create. We don't like to think about it, but the cost of long-term care in the United States is astronomical. A semi-private room in a nursing home can cost over $90,000 a year. In-home health aides can cost tens of thousands. Medicare doesn't typically cover these long-term custodial care costs. It's the kind of expense that can wipe out a lifetime of savings in just a few short years, leaving the healthy spouse destitute. Now, imagine if David had a life insurance policy with a chronic illness living benefit. The moment the doctor certified his condition, the family could have activated the benefit. Unlike the lump sum you might get for a critical illness, the chronic illness benefit is often designed to work more like a paycheck. The insurance company would advance a portion of the death benefit to the family every single month. This could have been thousands of dollars month after month. What would that have meant for David and Mary? It would have meant dignity. It would have meant options. They could have used that money to hire a professional in-home caregiver for a few hours each day, giving Mary a much-needed break and preserving her own health. It would have allowed her to keep her job and her own sense of identity. They could have paid for proper home modifications, like a walk-in shower, making David's life safer and more comfortable. That monthly check would have replaced her lost income, stopped the drain on their retirement savings, and transformed their situation from one of desperation to one of manageability. It wouldn't have cured David's illness, but it would have cured the financial crisis it created, allowing them to focus on what truly mattered: their time together. That's the second pillar of living benefits. And it leads us to the third, the one that people are perhaps most familiar with but often misunderstand. This is the terminal illness benefit. This is triggered when a doctor diagnoses you with an illness that is reasonably expected to result in death within a specified period, typically 12 or 24 months. This is the diagnosis that no one ever wants to hear. It's the final chapter. And in that final chapter, traditional life insurance has always had one cold, unchangeable rule. Your family only gets the money after you're gone. But a living benefit policy flips that script entirely. It says if this time is all you have left, you should have the resources to live it on your own terms. Let's think about a woman named Susan, a 45-year-old mother of two, diagnosed with stage 4 pancreatic cancer. The doctors give her a year. Her health insurance covers the treatments, the chemotherapy, the hospital stays, but it doesn't cover life. With a terminal illness diagnosis, Susan could accelerate a significant portion, sometimes up to 100% of her death benefit. Imagine a check for hundreds of thousands of dollars appearing in her bank account. Suddenly, her last year isn't defined by what she's losing, but by what she can create. She can quit her stressful job immediately. She can use the money to take her family on one last, unforgettable trip to see the Grand Canyon, creating memories her children will cherish forever. She can hire help around the house so she can spend her precious energy playing with her kids, not cleaning gutters. Maybe there's an experimental treatment in another state that her insurance won't cover. Now she has the money to try it. She has the funds to fight for every last second, without bankrupting her family in the process. She can use the money to pay off the mortgage, ensuring her family will always have their home. She can even prepay for her own funeral expenses, lifting that logistical and financial burden from her grieving husband's shoulders. The terminal illness benefit transforms the death benefit from a legacy you leave behind into a tool you can use to shape your final days. It provides peace of mind in the most stressful time imaginable. It's about dying with dignity, with control, and without leaving a financial disaster in your wake. So now you see the three-legged stool of living benefits: critical, chronic, and terminal illness. Each one is designed to protect you and your family from a different kind of financial nightmare while you are still alive. But this brings up a very important and very logical question. If you're taking this money out of your policy while you're alive, what happens when you die? Does this money just come out of thin air? The answer is no. It's crucial to understand that this is not free money. When you accelerate a portion of your death benefit for a living benefit claim, your death benefit is reduced by that amount. You are, in essence, using your own death benefit for yourself while you are alive. If you have a $500,000 policy and you accelerate $150,000 for a critical illness, your beneficiaries will now receive $350,000 when you pass away. It's a trade-off. You're trading a portion of the legacy you leave behind for the financial survival you need today. And for most people facing a life-altering diagnosis, that is a trade they would make in a heartbeat. Because what good is $1 million death benefit to your family if they've already lost their home and their savings just to help you survive? This concept of accelerating your own death benefit is what makes this entire structure so powerful. But it also leads to the single biggest question that everyone has when they first hear about this. It's the question you're probably thinking right now. If a life insurance policy can do all of this, if it can protect me from a heart attack, from long-term care, from a terminal diagnosis, it must be incredibly expensive, right? This has to be some kind of gold-plated, premium feature that doubles or triples the cost of a regular policy. How much extra do you have to pay for this incredible financial safety net? The answer to that is going to shock you. For most people, the answer is zero. Nothing. Nada. It costs you absolutely nothing extra in premium to have these living benefits, these accelerated benefit riders, built into your life insurance policy. Let that sink in for a second. The ability to access hundreds of thousands of dollars tax-free if you get sick is often included for free. It's a standard feature, not a luxury add-on. Now I know what you're thinking. That's impossible. Nothing in finance is free. There has to be a catch. And you are 100% right. There is a catch, but it's not what you think. It's not a hidden fee or a secret charge that shows up on your bill. The catch is in how it works, and understanding this is the key to unlocking the entire concept. To get it, we have to rewind the clock a bit. For decades, if you wanted this kind of protection, you had to buy something called a long-term care rider. And these riders were, and still are, notoriously expensive. You might have a life insurance premium of, say, $200 a month, and the long-term care rider could add another $100, $200, even $300 a month on top of that. It was a massive additional cost. Why? Because it was providing additional benefits. If you had $1 million policy and $1 million long-term care rider, the insurance company was on the hook for a potential $2 million payout. It was a separate pool of money, but that's not what we're talking about here. Modern living benefits are not a separate pool of money. They are an acceleration of the benefit you already own. That's the magic word. Acceleration. You are simply getting a portion of your own death benefit paid out to you early while you are still alive. Let's use a real-world example. Let's say you have a $500,000 life insurance policy, with these living benefit riders included at no additional premium cost. You're paying your premium every month, everything is fine. Then you have a massive heart attack. You survive, but the damage is severe. You can no longer work, you have piles of medical bills, and you need to make modifications to your home to accommodate your new physical limitations. You are in a desperate financial situation. So you file a claim against your life insurance policy's living benefits. The insurance company's underwriters swing into action. They get your medical records, they look at the doctor's reports, and they confirm that yes, you have suffered a qualifying critical illness as defined in the policy. Now here's where the catch comes in. They don't just send you a check for $500,000. If they did that, there would be no death benefit left for your family, and the insurance company would be out the full amount years earlier than they expected. Instead, they do a calculation. It's a complex actuarial formula, but it basically boils down to this. They look at your new reduced life expectancy because of the heart attack. Let's say that based on their models, your life expectancy has been significantly shortened. They know they will have to pay out that $500,000 eventually, but now it's likely to be much sooner. So they make you an offer. They say, based on your current condition, we can offer you an accelerated benefit of $300,000 right now. Cash. Tax-free. You have a choice. You can accept the offer or you can decline it. If you accept it, they send you a check for $300,000. You can use that money for absolutely anything. Pay your mortgage, cover your hospital bills, hire a home health aide, take a family vacation to make memories. It is your money with no strings attached. So what happens to the rest of your policy? The remaining $200,000, $500,000 minus the $300,000 you took, stays in place as your death benefit. You continue to pay the premiums on the policy, though sometimes these are waived, and when you eventually pass away, your family will receive $200,000. That is the cost. The cost is not an extra premium. The cost is a reduction in your final death benefit. You are trading a future larger benefit that you will never see for a smaller, but still life-changing benefit that you can use today when you are in the fight for your life. Think about the power of that. In the absolute worst moment of your life, when you feel like your world is collapsing, you get handed a financial lifeline. A tax-free check that solves your money problems so you can focus on what really matters: your health and your family. And this is why the insurance companies do it. It's not pure charity. It's smart business. They have a $500,000 liability on their books, your policy. They know they have to pay it someday. By offering you $300,000 now, they get to settle a $500,000 liability for a discounted amount. They close out a large portion of their risk early. It's a win for you because you get a massive amount of cash when you need it most. And it's a win for them because they fulfill their promise to you while also managing their own financial risk. It's a true win-win scenario, which is incredibly rare in the world of finance. The same logic applies to a terminal illness diagnosis. If a doctor says you have less than 12 or 24 months to live, the insurance company knows with near certainty that they'll be paying that death benefit soon. So, they might offer you an even larger percentage of your death benefit upfront, maybe 80 or 90%. Why? Because they can give you, say, $450,000 now, and you can use that to get the best experimental treatments, put your affairs in order, or fulfill a lifelong dream. They get to close their books on the liability, and you get to live out your final days with dignity and without financial stress. This concept completely flips the script on life insurance. It's no longer just a morbid contract that only pays out when you're gone. It becomes a living, breathing asset. It's a bank account you hope you never have to withdraw from, but if you do, it can save you from financial ruin. Let's contrast this with the alternative. Imagine that same person with the $500,000 policy, but without living benefits. A traditional old-school policy. They have the same heart attack. They can't work. The bills pile up. What are their options? They can start draining their 401k, paying massive taxes and penalties for early withdrawal, and destroying their spouse's retirement in the process. They can sell their house, uprooting their family during an already traumatic time. They can go into deep, crushing debt, borrowing from family or taking out high-interest loans. They can declare bankruptcy. Their life insurance policy, that $500,000 asset they've been paying for, just sits there, useless. A piece of paper that only has value the moment they die. It's a cruel irony. They own a $500,000 asset that they can't touch, while their life is financially unraveling. That is the difference. It is night and day. And the fact that this protection, this feature that can prevent bankruptcy, foreclosure, and overwhelming debt, is often included for no additional premium is frankly one of the best-kept secrets in personal finance. It transforms a simple death benefit into a comprehensive financial safety net for your entire life. So, the cost isn't in your monthly payment. The cost is a choice you make at the worst time of your life. Trade a portion of your death benefit for cash in hand. And let's be honest, for most people facing a life-altering illness, that's not a difficult choice to make. Having $300,000 to save your home and pay for treatment is infinitely more valuable than your kids getting a slightly larger check a decade or two down the road. But this brings up the most important question of all. If this is so revolutionary, and if it doesn't cost extra, does that mean every single life insurance policy automatically includes it? Is the policy you bought 10 years ago equipped with this modern-day superpower? Is the policy your employer offers you at work the right kind? The unfortunate answer is no. Not all policies are created equal. Many older policies and even some newer, cheaper ones don't include these riders. And the difference between a policy that has them and one that doesn't isn't just a detail in the fine print. It's the difference between financial security and financial ruin. So how do you find out if your policy has them? And if it doesn't, how do you get one that does? What are the exact words you need to look for? Let's pull back the curtain. The magic words you're looking for inside your policy documents are usually called riders. A rider is simply an add-on to a core policy that provides supplemental benefits. For living benefits, you're hunting for three main types. First, the terminal illness rider, or accelerated death benefit rider. This is the most common one. It allows you to access a portion of your death benefit if you are diagnosed with a terminal illness and have a life expectancy of, typically, 12 to 24 months. Think of it as an early inheritance paid to you when you need it most for experimental treatments, hospice care, or simply creating final memories with your family without financial stress. Second, you're looking for a chronic illness rider. This is the game changer for long-term care scenarios. This rider kicks in if you can no longer perform 2 of the 6 activities of daily living, things we take for granted like bathing, dressing, eating, or getting in and out of a bed. It can also be triggered by a severe cognitive impairment like Alzheimer's or dementia. This is the rider that helps pay for a home health aide or a nursing home, protecting your retirement savings from being wiped out by astronomical long-term care costs. Third, and critically important, is the critical illness rider. This rider pays out a lump sum tax-free benefit if you suffer from a qualifying critical illness. The most common triggers are a heart attack, a stroke, or an invasive cancer diagnosis. But policies can cover a dozen or more conditions like major organ transplants, kidney failure, or paralysis. This is the money that replaces your income while you're recovering. It's the money that pays the mortgage, the car payment, and the utility bills when your paycheck stops but the world keeps spinning. So, your first step is an intelligence mission. Go find your life insurance policy. I know it might be in a dusty binder or a forgotten file folder. Find it. Blow the dust off and open it up. You're looking for a table of contents or an index. Scan for words like riders, endorsements, or additional benefits. Under that section, you need to see the specific names: terminal illness, chronic illness, critical illness. If you see them, that's a huge first step. But don't stop there. You need to understand the details. What percentage of your death benefit can you access? What are the specific triggers? Is there a waiting period? Now, if you can't find your policy, or if you're looking at it and it feels like it's written in a foreign language, do not get discouraged. Your next step is even simpler. Pick up the phone. Call the 1-800 number on your billing statement or your insurance card. When you get a representative, you say this: "Hi, my name is," your name, "and my policy number is," your policy number. "I'm doing a review of my coverage, and I need to know if my policy includes any accelerated benefit riders for terminal, chronic, or critical illness." It's that simple. They have to tell you. But what if the answer is no? What if you do this check and discover your policy is a death benefit-only plan? First, don't panic. You've just uncovered a critical vulnerability in your financial plan, and now you have the power to fix it. Your old policy isn't worthless. It served a purpose based on the technology available when you bought it. Think of it like a car from the 1980s. It had an engine, it had wheels, it would get you from point A to point B. But it didn't have airbags. It didn't have anti-lock brakes or stability control. At the time, it was the best you could get. But today, knowing what we know about safety, would you knowingly buy a brand new car for your family that didn't have airbags? Of course not. The technology has evolved. The standard of care has changed. Life insurance is the exact same. A policy from 15, 20, or 30 years ago was built on the best chassis available at the time. It paid out when you died. But the industry has had a revolution. Modern policies are built with the financial equivalent of airbags and crumple zones. They are designed not just for the crash, which is death, but for the violent, financially devastating impacts that happen on the way to the crash, like a heart attack, a cancer diagnosis, or a long-term care event. So if your policy doesn't have these features, you generally can't just call up and add them on, any more than you could call Ford and ask them to install airbags in your 1985 Mustang. You need to look at upgrading to a modern vehicle. You need to explore a new policy design for the 21st century. And I can hear the objections now. But won't a new policy be more expensive? Not necessarily. In fact, for many people, it's surprisingly affordable. The reason is that these living benefit riders are often included at little to no upfront cost. The insurance company isn't just giving away free money. The way it works is, if you use the benefit, say you have a $500,000 policy and you accelerate $100,000 for a critical illness, your death benefit is then reduced. There might be an administrative fee, and the amount you receive is discounted based on your age and current life expectancy. But the core principle is you are accessing your own death benefit while you are still living. You're simply changing the timing of the payout to a moment when it can literally save your financial life. Another objection. But getting new insurance is a hassle. I don't want to do the medical exams. The industry has changed here too. For many applicants who are in reasonably good health, you can now get hundreds of thousands or even millions of dollars in coverage through accelerated underwriting processes that use data and algorithms instead of needles and nurses. The process can be faster and less invasive than ever before. The most dangerous objection, though, is inertia. The voice that says, "I already have a policy. I'm fine. I'll deal with it later." But later is a thief. Later is what Mark, the engineer from our story, was counting on. He had a policy. He thought he was fine. But his policy was an old model, a car without airbags. And when the crash came, it offered no protection for the impact. It only paid out after the wreck was total. His family got the death benefit, yes, but only after they had lost their house, their savings, and their sense of security. Compare that to Sarah, the teacher. She had a modern policy. When her cancer diagnosis came, it was like her financial airbags deployed instantly. The critical illness rider injected $100,000 of tax-free cash into her family's accounts. It was a financial shock absorber. It didn't cure her cancer, but it cured the financial disease that always accompanies it. It gave her the one thing money can buy: options. The option to choose the best doctor, not just the closest one. The option to take time off work without worrying about the mortgage. The option to focus 100% of her energy on getting well, instead of spending it terrified of bankruptcy. This is the entire point. Life insurance with living benefits fundamentally changes the question from, "How much is my family going to get when I die?" to, "How can my family and I be protected if I get sick or hurt along the way?" It transforms a one-dimensional product into a three-dimensional financial safety net. It's not just death insurance anymore. It's life insurance in the truest sense of the word. So here is your mission should you choose to accept it. Within the next 24 hours, find your policy or make the call. Ask the question, do I have riders for terminal, chronic, and critical illness? Get a clear yes or no. If the answer is yes, congratulations. You have a modern tool protecting your family. Your next step is to understand the details so you know exactly what you have. And if the answer is no, congratulations to you too, because today is the day you discovered the gap. Today is the day you learned that your financial vehicle is missing its airbags. And today is the day you can start the process of upgrading your protection. Don't see it as an expense. See it as the most profound investment you can make in your family's peace of mind and your own dignity during a crisis. Don't let your life savings, your home, your entire future be one diagnosis away from disaster. Find out what your policy actually does. Because knowing you're protected is a powerful feeling. But finding out you aren't when it's already too late is a tragedy that you have the power to prevent, starting right now.